Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, we're working on your financial freedom. On today's show, I'm going to talk a little bit about unforeseen circumstances. Yeah, unforeseen circumstances. These are things that you need to anticipate. These things can happen to you at literally any time, any place. Like what happened to me a half an hour ago. See, a half an hour ago, I was preparing for the show. I was working on some great stuff. I was reading some stuff, and I thought, this is good content that you want to hear. So I was putting all this stuff together, and all of a sudden I went to a website, and I clicked on the website, and nothing happened. My web browser came up and said, "You have no internet connection." And I went, this is not good. So the first thing I did was I called my internet service provider and I said, okay, what's going on? And of course, I got the automated system telling me that maybe sometime later today they would get around to restoring my internet connection. Well, that didn't work very well for me because I've got information I want to share with you. So what I did was I got in my vehicle, I drove down the interstate to my local Lifestyles Unlimited office, because I know that we have internet down there. So I'm actually in the San Antonio office right now. And this is a great place for me to be right now. And here's why. Lifestyles Unlimited is now emerging from the coronavirus lockdown. We are planning more and more live events. And the reason we do this is because live events are so important for that human contact, that ability to talk with another investor, to understand what that investor is trying to do to change their life as they are working on a revised retirement plan. So as I was driving down to the San Antonio office, I decided I would go ahead and change the theme of the show. I decided that what I would do is I would talk to you about what just happened to me, an unforeseen circumstance. Contingency planning is something you need to address. Yeah, it is. Whether it's in your life, whether it's in your business, whether it's in your rental properties, whether it is working with your children, playing baseball, football, soccer, whatever they do, you need to have contingency planning, because no matter how solid your plan is, life happens. And life happens on a daily basis. And there are things that will occur to you on a daily basis that may impact your flow, impact what you're trying to do. Now, there are people that get kind of flustered when that happens. I mean, there are people that have such a solid routine that when they deviate from that routine, they feel very uncomfortable. Now, there are other people that don't even have a routine. They could care less. They just kind of go through life willy-nilly. I'll just react to life as life occurs. And I think you're probably someplace in between the two of them. I think you are, because I'm in between the two of them. Those are what I consider to be the extremes. The rest of us operate in that middle space. The rest of us understand that there are things that will occur to us that we have absolutely no control over. But if we have been diligent, if we have sat down and we have thought about what could potentially happen to us in the future, we're better prepared for when it does occur. Now, I'll tell you, I spent, and you're probably tired of me telling you this, but I'll tell it to you again. I spent 27 years in the United States Army. And in that time period, I spent a lot of my time focused on planning. And here's the big takeaway when it comes to planning. I'll just give you the big takeaway. And this is the one thing that I learned in the Army that always proved true when it came to planning and specifically to contingency planning. You ready for it? Okay, here it is. Plans are useless. They are. Plans are useless. But the art of planning, now that right there is the fundamental concept that you need to put in your arsenal. See, we can make all kinds of plans. And in the environment that we operate in, those plans may come to fruition or they may not. So what happens when they don't? Well, that's where contingency planning comes in. That's where you take a look at what can I do to affect the situation if the situation changes. Now, you guys are going, okay, man, you're losing me, Al. Stop. Bring this back together. Okay. All right. Sorry. This is what happens in my brain when I start talking about planning, contingency planning and stuff like that. I go all over the place because I want to anticipate anything that can go wrong, and I want to have a chance to address that problem before I actually have to deal with it. Because when you get to that point where you actually have to deal with it, you may not be well prepared for it. So when it comes to real estate investing, the one thing that you must do, this is a constant, this is a you must do. You need to sit down and figure out where do you want to be in the next 5 years. Yeah, you have to formulate in your mind an idea of what your life is going to be like in the next 5 years. And then you work your plans backwards to today to figure out how am I going to get from here today to there tomorrow. And you can make a nice linear plan and it looks all pretty. And you can put it up on the wall and you can look at it every day and it will reinforce your mind. But you always need to be thinking about contingencies. You always need to be thinking about what if. And it's no different with real estate investing. We come back from the break. I'm going to share some thoughts with you that'll make your head go.
Warning. Listening to the Lifestyles Unlimited Real Estate Investor Radio Show will change your life. We will teach you how to create wealth and passive income so you can be financially free. And now, back to your host.
When it comes to things like IRAs, 401ks, 403bs, 457 plans, simple plans, those types of things, to include SEP plans, I found it very interesting that there were limits to the amount of money you can actually put into those accounts. For instance, IRAs, you're allowed to contribute $6,000 into an IRA account. That was according to tax year 2020. I'm not quite sure what the 2021 number is. I didn't bother to look that up because I don't invest in those things. But I think it's very curious that within something designed to be a retirement account, you're only allowed to contribute $6,000 into that account. Now, it does say on the source that I'm looking at that you can put $7,000 in if you're age 50 or older. And then they have a catch-up thing of $1,000. And I don't mean ketchup like ketchup and mustard. It's talking about catch-up contributions that you can make of $1,000. You know, it's kind of baffling to me
Because let's say you're 50 years of age, and let's say you decide you're going to invest into an IRA. You want one of those accounts. You, I, the people down the street, as far as I know, we can all get IRAs. And the type of IRAs is dependent on whether we want pre-tax or post-tax contributions. But let's say we're 50 years of age. We're going to invest $7,000 per year into that IRA. Over a period of 20 years, we will have invested about $140,000. And let's assume that the investments that we make, they grow over time. So whatever you're buying in your IRA is creating a return. And most financial planners are going to tell you 7 to 8%. Some will say about 10%. I mean, if you look at what the stock market is doing right now, the stock market is very healthy right now. And it's growing. Based on what I saw today, it's at new highs on the Dow. And the NASDAQ is back up right at its 50-day trading line. So it appears to be healthy. Appears, however. The market always appears to be healthy before it's not healthy. Yeah, it's just the way it is. But if you save $7,000 a year and you put it into that IRA, and let's say it grows at like 10%, assuming over time, maybe that IRA gets to, I don't know, let's pick a number. Let's go with, I like 170,000. We'll go with 170,000 because I don't know if you're going with a very safe and secure investment strategy. I don't know if you're going with an aggressive investment strategy. I don't know if you're middle of the road. I mean, consider the fact you're 50 years of age when you start and you are planning to contribute up until the age of 70. Chances are you started maybe more aggressive and you became more cautious as you went through the investing paradigm. So let's assume you have $170,000 in that particular account. You get to the age of 70, you've deferred all of your Social Security up until the age of 70, and you start taking that Social Security out. And let's say you get $3,000 a month in Social Security. Now, keep in mind, that's in the future. So $3,000 a month in the future will not necessarily buy what $3,000 a month buys today. That just has to do with the fact that prices have a tendency to increase over time. There is a thing called inflation that occurs, and money is measured based on a standard of $1972. Yeah, at least that's what I was taught. So you've got $170,000 sitting in that account, and you decide that you're going to draw that account down. And maybe, just maybe, you need an additional $3,000 per month to live. What will happen to your account is you'll start dwindling it down. You will start consuming that money, and that money will last you about 56 and a half months. Now, if we equate that to real years, it's going to last you a little over 4.5 years, meaning if you don't find a way to replenish that account at the age of 74 and a half, you're going to revert to just living off of Social Security. So all of a sudden, the lifestyle that you were sustaining in your early to mid 70s will now revert to just what Social Security pays you because you will have consumed all that money in that retirement account. Yeah. Real estate, however, has a different approach. Real estate allows you to utilize the money that you earn in the form of passive income, and we call that cash flow. And when you invest correctly into real estate, that real estate should be paying you 5 different ways. It should be providing you cash flow, and that's money that you can use to live off of. It should be providing you an opportunity to capture equity. You capture equity when you buy property at wholesale property prices, renovate the property, and then put it back in the marketplace, and it has a higher value. That's equity that you capture within the deal. Real estate also pays you in the form of appreciation over time. Appreciation over time is a natural function of real estate. Real estate tends to double in value every 20 years. You also have the benefit of the mortgage that you place on that property paying down over time. See, when you make your mortgage payment, a portion goes to principal and a portion goes to interest. And the portion that goes to principal is actually decreasing the amount that you owe. So it's actually going in the opposite direction of the appreciation of the property. The final way we make a lot of money in real estate is by taking advantage of the tax advantages afforded to us as real estate investors. See, the tax advantages allow us to use something called depreciation to offset the cash flows that we earn on the property. It's a really neat effect. When we come back from the break, I'm going to talk to you a little bit more about the money flow. Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. If you're just joining me, what I've been doing is talking about the concept of contingency planning. Now, contingency planning is something that organizations do day in and day out, because the biggest problem that occurs to your business environment is the impact of unforecasted events. Yeah, I mean, because life happens, right? So let's put it in the real estate context. So you decide that you're going to go buy a single family rental home. And that's I'm with you, man. I'm there with you, because that's where I want you to be. I want you to get to the place where you are starting to invest your hard-earned money into assets that you have control over. And when you do these things, it's going to change your life. So you take a look at a single family house. And this particular house, I mean, it's got all the things you're looking for. It's, first of all, it's kind of beat up. It's kind of nasty. Okay, you walked in, it didn't smell very good, so that's always the smell of money. You know, if you walk into a property and it just doesn't smell very good, chances are other people will smell that too, and they'll go, oh no, I'm not dealing with that. So that's a good thing for you. But you buy this property and you're going through an option period. And during the option period, what you're doing is you're doing inspections. You're having either yourself or somebody that you have selected who knows what they're doing go through the entire property. You're going to take a look at all of the systems. You're going to take a look at all of the functional elements of that property. You're going to look at the very top of the property where the roof is, and you're going to make an assessment as to whether or not there's serviceability in that roof. You're going to take a look at the bottom. You're going to take a look at the foundation. Maybe it's a concrete slab foundation. Maybe it's pier and beam. It really doesn't matter what kind of foundation, but you need to take a look at that foundation, and you need to figure out if something needs to be done to that foundation. You're going to look at the entire system of the house. Yeah, everything. I mean, we're talking about AC, we're talking about heating, we're talking about plumbing, we're talking about, plumbing is two phases, right? You got the incoming water supply and you've got the outgoing waste supply, right? Okay, so there's two elements to plumbing. Now, some people figure things like electricity and gas, those are just kind of already there. But you may need to take a look at what type of electrical systems or gas systems are in that property, because depending on the age of the property, there may be some problems. And this gets me to that concept of contingency planning. See, you looked at the roof and you said, I don't know. This property, it's very old. You don't know when the last time a roof was put on this property. I mean, you can look at roofing material and it can look the same on day one as it does on day one and 30 years from now. It really can look similar, but the consistency of the materials break down over time. And when they break down over time, that gives you the peril. So you take a look at the roof and you go, okay, the roof looks okay, but you bring your roofing person out because you want somebody that actually knows the business of roofing to put some eyes on this thing. So the roofer comes back to you and he or she says, okay, the roof looks like it has some serviceability to it. So what the roofer's telling you is that the roof's doing okay. There's no signs of leaks. There's no signs of any other problems. However, there are signs of aging. So one of the things that the roofer is going to tell you is they're going to give you feedback on that roof and give you a recommendation on any repairs that need to be made immediately, and a recommendation on the lifespan of that roof. And here's where your contingency planning comes in. Let's say you've got a roof and it's got maybe 3 years of lifespan on it. I mean, you brought your expert out and your expert said, yeah, this thing's got 3 years of lifespan. But when you decided to buy this property, you wanted to hold it for 5 years. Okay, so now you've got an issue that you need to deal with. Do you accept the roof in its current condition, expecting serviceability out of it for at least the 3 years the roofer said that you should have serviceability, and then will you get that extra 2 years of roof lifespan for that final 2 years that you plan to hold that property, or will it fail? So you've got a decision to make. You're either going to budget to replace that roof now. At Lifestyles Unlimited, we like to look at everything, every system in the property, and determine whether or not it has a 5-year lifespan to it. At least a 5-year lifespan. If it doesn't have a 5-year lifespan, we will repair it or we will replace it. And we will do whatever is necessary to get it to a 5-year lifespan. So now you've got an issue with the roof. It's potentially got 3 years, maybe could go 5 years. I don't know. Do you spend the money now to re-roof the property? Go ahead, make the roof whole, therefore eliminating probably any problems with that roof. Or do you just say, yeah, the roof is fine. But then you make a contingency plan. You make a contingency plan so that if that roof fails during the lifespan that you plan to hold that property, that you have monies set aside in reserve to spend on that roof to make all necessary repairs or potentially to replace it in the future. Yeah, that's kind of what contingency planning is. So, you make a decision here and now, and then you make a decision regarding what you anticipate the future to hold. Now, I'll be the first one to tell you, that's a hard call. That is a hard call because, a roof could cost you maybe $10,000. And if you don't have to replace the roof, why would you drop an extra $10,000 into that property? I mean, that's one of those questions that you have to ask yourself. The other question you have to ask yourself is this. If you run the risk of not replacing the roof, are you okay with setting aside money that you may need to use in the future to make that repair? Lifestyles Unlimited members debate these types of things. We do. We talk about these things. Do you fix it? Do you not fix it? Okay, but when you don't fix something, you're taking on risk. And risk can be problematic. Yeah, risk can be very problematic because it's the risk that creates all these problems for you that make you have contingency plans so that when you have something fail on you, you have the ability to correct it. Let me just give you a very simple example of a contingency plan. You've fixed up your property, you're owning and operating it, you're like 2 years into ownership of the property, everything seems to be going on, you've got a great resident living in the property, life is good, all right? The resident basically said, hey, you know what? I'm going to sign up for another 1-year lease because I love this property. You're a great landlord. You take care of stuff, and you're providing me the clean, functional workforce housing that I need. I appreciate that. So they sign the lease. 3 months into the lease, all of a sudden, your resident, who happens to be a member of the military, gets orders to relocate to another part of the country. Okay, you didn't know that was coming. You need to have a contingency plan in place to remedy that. So if you have a contingency plan in place to remedy that, you're going to be just fine. Kind of gives you an example of contingency planning. We come back from the break, I've got more info to share. Stick around.
We're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Welcome back to the show. So in real estate, there are actually contingency plans that are built into real estate contracts. You may or may not be aware of that, but yeah, there's contingency planning that is built into those contracts that those real estate agents that you work with provide to you. And I mentioned one of those contingencies briefly in the last segment. I was talking about when you go to buy a property, if the property is not a wholesale property, in other words, it's a property that is being offered through like the multiple listing service, it's not a property that we consider off market. It's a property that is being offered across the marketplaces. So when we buy one of those types of properties, it's not a wholesale property or an off market property, that kind of thing. What we'll do is we will ask for an option period. In other words, a time period where the seller of the property will stop marketing the property. They will stop entertaining other offers because they will have accepted our offer to purchase. But for 7, maybe possibly the first 10 days, depending on what you negotiate, you're going to have a time period where you're going to be able to look at all of these systems within that property. You're going to have an opportunity to inspect them. You're going to have an opportunity to see if they work. You're going to have an opportunity to determine what you think is their functional lifespan. And the reason you do this is because you're gathering data. You are gathering information about all these different systems because you're trying to figure out, okay, is it going to be good for the next 5 years or not? If not, what's it going to cost to bring it back to its original lifespan? So we factor all these things in. So if the roof needs repairs, we factor a cost for that. If the foundation needs repair, we factor a cost for that. If the plumbing is not operating correctly, or there's clogs or something in the waste treatment lines that needs to be remedied, or maybe the sewer system itself is just leaking into the ground. Yeah, that happens. There's a cost associated with fixing that. There's a cost associated with renovating the kitchen and the bathrooms. You know, some of what's in there may be just in great shape, but you've got to figure out what it's going to cost to bring it to your standard. There's a cost associated with the flooring. There's a cost associated with repainting the property. Maybe you don't like those popcorn ceilings and you're going to scrape those off. There's a cost associated with that. So what you're doing in this contingency period that you have, the 7, maybe 10-day period, is you're doing a full-blown analysis on this property to validate, you heard me correctly, to validate whether or not this property will make sense for you based on your original back-of-the-napkin analysis. And if it doesn't, then you respectfully withdraw from the contract. And if the contract was written correctly, all of the monies that you put down on deposit will come back to you. You will walk away. You and the seller will just part ways, and that's going to be fine. It's going to be totally fine. So you want contingencies in your deal flow. You do. You want protections. Now, there are time periods where you may find a property that is really being marketed at a good price. Maybe this opportunity is coming from a wholesaler. Now, wholesalers are not real estate agents. They are just people that are trying to make some money flipping contracts. That's what they're doing. They're flipping contracts. So they go out and they find somebody that's interested in selling their property. And for whatever reason, they just can't get that property sold. In many cases, distressed properties have a tendency to be sold through wholesalers. And the reason for it is people may have tried to sell the traditional way, and it just didn't work. So a wholesaler contacted them and basically said, look, I will pay all cash for your property. Give me a couple of weeks to put everything together, and I'll make this property go away for you. I will take the burden of this property off of you. And the seller agrees to that contract. And then once that wholesaler gets that contract, they come to people like me who buy these types of properties, and they make them available. Okay, and there's usually a fee associated with turning that contract over to us. I mean, it's kind of like a finder's fee. I mean, there's probably no better way to describe it. Essentially, the wholesaler went and did all the hard work to go out and find this particular asset and made it available to you. So, they were entitled to a fee for bringing that deal to you. Now, when you're dealing with property like that, chances are you're not going to get a contingency. Yeah, because the contract's already been written. And if there was a contingency clause in that contract, chances are there wasn't. But if there was a contingency clause in that contract, it's probably already been used up while that wholesaler was out trying to flip that contract. So in this particular instance, you have to be prepared as a very sophisticated investor to absorb the potential contingencies that would come from you taking on this property without having a contingency period. So what am I getting at? Let's just get right into it. I don't think you should be buying wholesale properties as your first property. I just don't. I don't. That's just my opinion. That's Al's opinion. I'm not saying that's a Lifestyles Unlimited opinion. I'm not saying that's anybody else's opinion than mine. And here's why. Unless you are experienced, unless you are well-grounded in the different systems that make up residential income producing real estate, it becomes very risky for you to buy a property that seems like it's going to be a good deal without knowing the costs associated with renovating different elements of that property. So in other words, when you become more experienced, you're going to have a higher comfort level with what it costs to do different things. You'll know what roof replacements cost versus roof repairs. You'll understand what a full foundation repair costs based on square footage and based on whether it's pier and beam or concrete slab versus a partial fix that needs to be done on the property. You'll have an understanding of what it costs to put flooring by square footage into a property. You'll have an understanding of what it costs you to renovate kitchens and bathrooms to bring them to your standard. You'll have an understanding of what it costs you to paint. So when you go into these types of deals as a experienced, sophisticated investor, you can absorb some of the risks of not having a contingency clause built into your contract because you've got a few of these under your belt. You have a very solid knowledge base that you didn't have when you were starting out. That's my opinion. And as such, you'll be able to absorb contingency issues based on what you know about the marketplace. There's certain things that you will develop an understanding of as you expand your knowledge base of costs and materials and all this stuff. And trust me, it's not that hard to do this stuff. You just hang around with us. This stuff, you'll absorb this stuff because we talk this stuff. You'll be able to go out and buy a wholesale property, and even if maybe it costs you an extra $5,000 to do the renovation on that property over and above what you thought it was, you'll have a contingency plan in place to remedy that expense, and you will have built in a cost value for that contingency. It's the concept of, okay, I scoped all the lines, everything looks clear, but there's a lot of trees growing on this property, and we did notice that there was some root intrusion to the sewer line, so let's put a contingency cost in there in case we have to do some kind of blockage removal. It's that simple. It's really that simple. A lot of the investors that I know will give you a dollar amount for contingencies because they have enough experience, and if they don't have enough experience, they know enough people that have enough experience that share the information with them. So in the back of my mind, when I'm looking at a potential property, maybe it's a 3-bedroom, 2-bath, 2-car garage, 1,500 square foot property built in 1952 in a particular neighborhood, I'm going to know a lot of information already about the neighborhood and what serviceability of properties are in that neighborhood. And see, this is the point I'm getting to. Contingency planning is very important, but contingency planning really is not a substitute for actual knowledge. And if you really want to find out how to do this real estate investing thing, what you need to do is go to freeworkshoplivestream.com. And remember, it's not the money, it's the lifestyle.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.